Good morning, everyone. We're just waiting for people to sign on, so give us a few minutes here. Okay, good morning, everyone. My name is Josh Stripmatter, and I'd like to welcome you to Stripmatter Wealth's Smart Money webinar series. Thank you for joining us today. Our presentation is titled Summary of Tax Provisions for 2021 and 2022, and it will be presented by Brenda Young of SGA. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to a chat feature today, so if you have any questions, please don't hesitate to type those in. We'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email. So if you missed something, don't panic. We'll be sending this out to you, and you're welcome to share that replay with whomever you think might find it beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking action. And for more information, including key disclosures, please visit our website at stripmatterwealth.com. Now on to our speaker. Our speaker today is Brenda Young. And Brenda Young is a partner at SGA, located in downtown Fort Worth. She has extensive experience providing audit services to financial institutions and tax services to clients in a variety of industries. Brenda lives 70 miles from SGA and is often the first one to the office because of her dedication and determination in everything that she does. Brenda loves reading and is an avid sports fan. She's married and has 2 sons. So without further ado, let me introduce to you Brenda. Good morning, Brenda. How are you?
Good.
I know you've got a great presentation today for us. And there it is.
So the agenda today, I'm just going to tell you a little bit about Stovall, Grandey, and Allen, which we usually refer to as SGA. We're going to go over some key amounts and thresholds, business loss limitations, itemized deductions, business expenses, pending legislative changes, and other potential changes that have been discussed. So Stovall, Grandey, and Allen was founded in 1972 by David Stovall and Wendell Grandey. The firm was known as Stovall and Grandey at that time. Later, they brought in Harvey Watley, and the firm's name changed to Stovall, Grandey, and Watley. And then in 2005, the firm's name changed to Stovall, Grandey, and Allen after Mr. Watley retired. And Carol Allen joined the firm in 1983, and she became a partner in 1995. Mr. Grandey retired at the beginning of 2018, and Mr. Stovall is semi-retired. He still comes into the office some, but for all practical purposes, he's retired now. I joined the firm in 1999 and became a partner in 2005. In 2012, when Mr. Stovall decided that he wanted to take a more backseat role, that's when Carol Allen and myself bought the majority of the firm. And today we continue to manage the firm. And our motto is, it's more than numbers, it's year-round relationships. We strive to really provide a relationship. We are always available if our clients have questions. If we don't know the answer off the top of our head, we will find the answer for you. We're a full-service CPA firm. We provide tax, accounting, and auditing services to a multitude of businesses and individuals. And you can find more information about our firm on our website, which is listed on the slide. So some of the key amounts and thresholds, the standard deduction for 2021 for married filing jointly is $25,100. It's going to increase to $25,900 for 2022. A single filer is $12,550 for 2021, and then will increase to $12,950 for 2022. Head of household filers is $18,800 for 2021, and is going to increase to $19,400 for 2022. Married filing separately is $12,550 for 2021, and will increase to $12,950 for 2022, which is basically the same as what a single filer is. One of the things I'm sure you're all aware of is there's no longer a personal exemption. This was eliminated with the Tax Jobs and Cuts Act that was passed at the end of 2017. So IRA contribution limits, if the person is under the age of 50, it's $6,000 for 2021. If they're equal to or greater than age 50, it's $7,000, and there's not any change at this time for 2022. Simple IRA plan limits, under 50 is $13,500 for 2021, and 50 or over is $16,500 for 2021. These amounts are set to increase by $500 for 2022. 401k plans, 403b, and 457 plan limits under the age of 50 is $19,500 for 2021. 50 or over is $26,000. And these amounts are set to increase for 2022 by $1,000. Profit sharing plan and set limits, the contribution limit for 2021 is $58,000, and the compensation limit is $290,000. These are set to increase to $61,000 for the contribution limit and $305,000 for the compensation limit for 2022.
Brenda, to interrupt you for just a moment, we have a question on, do the IRA limits apply to Roth IRAs? And the answer is yes.
That is correct, yes. I'm sorry, I should have made that more specific. Social Security wage limits for 2021, that limit was $142,800. For 2022, it goes up to $147,000. One of the changes that occurred really as part of COVID is before the pandemic, required minimum distributions from retirement plans were required once you reach 70 and a half. But one of the changes that came out of some of the legislation related to the pandemic is that if you reach 70 and a half before January 1st of 2020, that you still have to abide by that 70 and a half age. But if you had not reached 70 and a half by the end of 2019, now the required minimum distribution age is 72. So for business loss limitations, one of the things in the Tax Jobs and Cuts Act is that it provided limitations on the amount of business losses that could be deducted by non-corporate businesses. So this would be like someone that has a Schedule C on their personal tax return. Also those that have flow-through entities that come in through their personal tax return. If it's from a trade or business, then it limited the amount of loss that they could take on their return. So for 2021, that loss limitation is limited to $524,000 for joint filers or $262,000 for all other filers. It's been kind of increasing each year. Initially, It started out at $500,000 for joint filers and $250,000 for all other filers. Any losses in excess of these amounts are carried forward to future years. So that is, let's say in 2021, you have losses of $275,000 and you're a single filer. So that means you've got $13,000 in excess losses. Those losses will be available to carry over to your 2022 tax return. And then if you have, say, business income at that time, well, then those losses could offset part of that business income. So on itemized deductions, the deduction for the mortgage insurance premiums expired 12/31/21. So that means for 2022, they will no longer be deductible. Also, one of the things that was in some of the pandemic legislation is that it allowed, in 2020, it allowed for non-itemizing taxpayers to deduct $300 in charitable contributions, kind of an above the line deduction. For 2021, that has increased to $600 for married filing joint filers, and it'll still be $300 for all other filers. And that's, you know, one of the things that we discussed earlier was just the increase in the standard deduction. And, you know, when they did away with the personal exemptions and kind of combined all of those into one, there are a large number of taxpayers that no longer have enough to itemize. And so, you know, this was just their way of allowing some of those that couldn't itemize any longer, that they could still get some deduction if they were making charitable contributions. As relating to business expenses, business meals and beverages that are purchased from restaurants, this can be dine-in, takeout. It just has to be purchased from a restaurant, are 100% deductible for 2021 and 2022. Those business meals and beverages that are purchased from non-restaurants are still 50% deductible for both of those years. One thing to remember is that this is just the meals portion. The Tax Jobs and Cuts Act in 2017 eliminated 100% of the deduction for the any entertainment expenses. Previously, they were 50% deductible as well. This doesn't change that. It's just relating to the meals. I'm sure it was just their effort in putting something, because the restaurant industry had been hit so hard by the pandemic. This was their way of trying to give kind of an incentive for businesses to maybe seek out and use those more if they were going to be able to deduct 100% of it instead of just the normal 50%. The 100% bonus depreciation for eligible property does expire at the end of 2022. For 2023, the 100% is reduced to 80%, and then there'll be further deductions until it's fully phased out as of the end of 2026. And so, you know, if you have a business and you're thinking about acquiring some new equipment, you know, if it's a vehicle that's over the 6,000 pounds, any of that kind of stuff, you want to really consider taking advantage of that before the end of 2022, because that 100% deduction in the year of purchase does go away. It reduces, like I say, to the 80%. Another change is the standard mileage rate for business miles. In 2021 was 56 cents a mile, and in 2022 that goes up to 58.5 cents. One thing that I didn't mention when we were talking about the itemized deductions is that remember the Tax Jobs and Cuts Act did limit the state and local tax that they refer to kind of as the SALT expense to $10,000 for filers. And so far that has not changed. So some of the pending legislative changes right now, the Build Back Better Act, which was passed by the House in November, some of the provisions in it is a one-year extension of the expanded child tax credit. As I'm sure you're aware, some of the pandemic legislation provided that they increased the child tax credit, from $2,000 up to, I think it was $3,600 for children under the age of 6. And then it was $3,000 for children over the age of 6. Well, they started sending out monthly checks beginning in July of last year that was to get some of this increase into the hands of the taxpayers. And so if they had children under the age of 6 and they qualified, then they were getting a $300 a month check. And if it was over 6, it was $250 a month. And so that all expired at the end of 2021. But this act is calling for an extension on that. There's also some extension of the changes to the earned income tax credit through 2022. The SALT limitation that we just discussed, they're proposing to increase that from $10,000 to $80,000 through 2031. There have been a lot of, the real estate taxes especially have just continued to increase. And so there's a lot of taxpayers where they're itemizing that they're losing quite a bit of deduction with this $10,000 limit as it is now. It also expands the premium tax credit that's relating to the healthcare cost. It's proposing a 15% minimum tax on profits of large corporations, and that's defined as those that have over $1 billion of profits. It's proposing a 1% surcharge on corporate stock buybacks. Another provision of the bill as it stands right now is a limitation on interest expense deduction to 110% of the domestic corporation's net interest expense. Reduces the deduction for foreign derived intangible income from 37.5% to 24.8%. It reduces the global intangible low taxed income deduction from 50% to 28.5%. And basically the global intangible low taxed income is income that's earned by foreign affiliates of a U.S. company from intangibles like patents, trademarks, copyrights. Another provision is to amend Section 1202 to disallow 75% and 100% exclusion of the gain from the sale of small business stock if your adjusted gross income is over $400,000 or if the taxpayer is a trust or a state. There's also a provision to amend Section 1411 to apply the tax to net investment income derived in the ordinary course of a trade or business for taxpayers with taxable income over $400,000 for single filers, $500,000 for joint filers, or $250,000 for married taxpayers filing separately. And basically, this is where the net investment income is basically unearned income. So that's going to be more like interest, capital gains, and so forth. But this provision would actually, if you go over these thresholds, it would actually apply it to the income derived in the ordinary course of a trade or business, which is pretty significant.
Hey, Brenda.
It would make permanent the Section 461 limitation on the excess business losses for non-corporate taxpayers that we discussed earlier. And it would impose a surcharge tax for high income taxpayers equal to 5% of the amount of the taxpayer's adjusted gross income that exceeds $10 million for joint filers, plus 3% of the amount that exceeds 25 million for joint filers. There's also several green energy incentives that are included. That's just, I mean, it's not 100% of what's in the Build Back Better Act, but that's some of the more prevalent, provisions that I felt were more applicable. There's, right now we're kind of in a landscape where it's hard to know what's going to happen, but there were a few things that I wanted, that have been discussed at different times that I wanted to make sure you're aware of, that there's always the potential that they could pass some legislation that affects those. One of them is the reduction in the lifetime gift exclusion. Right now for 2022, this amount is $12.06 million for an individual, or $24.12 million for married couples. And I know we've had
Brenda, are you there?
Yeah, can you hear me?
Yeah, your screen froze, and I think you're losing us. So I've got my screen up going. Just keep talking,
Okay,
and you're on slide 18, right?
Slide 15.
Slide 15, okay.
Well, it's other potential changes. Your slide numbers may be different than mine.
Okay, I think you're on slide 18. I'm on the pending legislation continued.
Okay, so the next one, the other potential changes.
Got it.
There you go. Can you still hear me okay?
Yes.
Okay. So this reduction in the lifetime gift exclusion, this is one of the things back, it was included in the Tax Jobs and Cuts Act when they increased it pretty significantly. And, it's not a permanent amount that's there. It's actually set, and forgive me, it may be 2026 that it's set to go back down to more normal levels, but it's certainly something that is on the radar that they could potentially change. And I know we've had numerous clients just in 2020 and 2021 that they have tried, if they had the ability, they've tried, if their estates were greater than these amounts, they've tried to take advantage of these limitations and go ahead and get the gifting out of the way, because to grandfather those. But if you haven't done the gifting and they revert, like this 12 million back down to, 5 million, well, you've kind of lost out on the $7 million that potentially you would have been able to gift and get out of your estate at that time. I mean, we don't have a crystal ball. So we have no idea if this will happen. It's just one of the things that we think it's something you may need to consider. Another thing that we've heard some discussions about is 10 or 20%. We've heard different things, but again, we don't really have that crystal ball and don't know if they will increase those. Another thing that we've heard some discussion about is potential elimination of the step up in basis upon the death of the person, because basically the way it works now is if you have property that, you know, their cost basis is say $100,000 because they've held it for, you know, 30 plus years, and at the time they die, the value is $1 million. Well, whoever that goes to would get that step up in basis, and so now their cost starts out at that $1 million. Well, there's been some talks about eliminating some of that, which, you know, is a pretty huge impact. I mean, one, just from a record keeping standpoint, when you think about some of these properties that have been in families for years, knowing really what the cost basis is pretty hard. And then, you know, Josh, the next slide. And then the other thing, you know, there's been so much stimulus funds through the PPP loans, you know, the stimulus checks that have gone out to taxpayers. They've got to figure out a way to pay for some of that. And so we kind of think it's probably a given that at some point they're going to have to increase the individual and corporate tax rates. You know, we don't really know when that's going to happen, but those are just some things that we wanted to kind of point out. There's a couple of other things that I didn't put on the slide that I just was going to mention is, I don't know if you're aware or not, but the IRS has really struggled the last couple of years. When the pandemic hit, they, you know, sent their personnel home. They really didn't have the infrastructure for them to be able to function good from home. It's just caused huge backlogs. And we heard earlier this week that they have reported that they still have millions of tax returns from 2020 that still have not been processed. And a spokesperson for the Internal Revenue has kind of said 2021 is going to be a really hard tax year. So that's not very comforting, because the last couple of years has been a struggle. You know, notices would go out. You couldn't reach anybody on the phone to try to take care of them. You know, so I'm just letting you know that that's still an issue. A lot of the trade organizations like the American Institute of CPAs and so forth are really encouraging members of Congress to see if there's not some kind of taxpayer relief through abatement of penalties and so forth that they can do to help, because basically now notices are going out to taxpayers. You can't get a hold of anyone to try to get it straightened out. And so, you know, they're kind of calling for them to put a halt to any type of collection efforts and so forth until they really get their organization, the backlog taken care of, where now they can take care of these problems before they get out of hand. We'll just have to stay posted and see. And then another thing, if any of you have had businesses or, you know, are self-employed and received the PPP loans and there was forgiveness, the IRS has come out with a notice where there's certain information about that. While it's not going to be taxable income, it is going to have to be reported through a statement on the tax returns. So I just wanted you to be aware of that so you could make sure that you get that information to your tax professional to ensure that it does get reported on the tax return. So Josh, the last slide. If you have any questions, there's my contact information. The best way to get a hold of me is really either by email or my cell phone. I stay gone and out of the office a lot. In fact, I told Josh I'm actually at a bank in Fairbanks, Alaska today. And when I walked over to the bank, it was 16 below. So I think it's probably a little colder here than what you're experiencing right now.
I think it is. Well, thank
Okay,
you,
now
Brenda.
Josh, I think I'm good. Just
Okay.
if there's any questions.
All right. Well, folks, thank you for joining us today. And if you have any questions, feel free to reach out to Brenda. If you have any questions that we can help you with, please give us a call. And please visit our website, stripmatterwealth.com, for our calendar of events that include our webinar schedule that we have coming up. We've got a Smart Money webinar every month with some great topics. So check out our calendar of events and you'll be able to see that. Also, we're teaching several college classes in the near future, so please check that out. We have a weekly market e-newsletter that you can sign up on our website that has some great insight into the markets. And then finally, join us every Saturday at 10 a.m. for our radio show called Ask the Experts on 1190 a.m., where we answer your financial questions on a wide variety of assortments and topics. And thank you again. We look forward to seeing you next time.